the kicker office. The kicker is not when you overpaid your taxes. The kicker is when I underestimate state revenues 2 years in advance. And we've had a few rounds of that lately, and looks like we're going to have another round of that because the economy continues to boom. We're in this inflationary boom that is really something we haven't seen in generations. And overall, it's good news. There's different challenges, there's different struggles associated with an inflationary boom, but it's much better than what we went through last cycle, where we had a financial crisis, and coming out of that, and we took took like 6 years to get back coming out of that, because we had aggregate demand was too low, debt was too high at the household level, and people didn't have the money, and they're trying to pay down the debt and grind their way out. And we had a real estate bubble, all sorts of stuff that was really, really bad and took forever to get back. Well, this time we had a 10% hole in the economy from the pandemic, which is massive. Overnight, we shut things down to stop the spread of the virus to varying degrees of effectiveness. And then we filled that 10% hole of the economy with 25% worth of GDP of federal fiscal policy. So we had a big hole, but then we more than plugged it. And so what do we see? Is we just got some new data, some official data last week, where despite a severe recession, despite record levels of job losses and shutting down swaths of the economy, as you guys know, the financing side of things for households have never been better, honestly, right? Is that household incomes grew. The chart on the left, median household incomes, math refresher, median is the midpoint. So 50% of households in Oregon have income lower than this. 50% of households in Oregon have income higher than this. So how is the typical median household doing? Incomes grew last year overall, despite the job loss, despite everything else. The federal aid more than offset that. Incomes grew. On an inflation adjusted basis, it was flat because inflation is picking up, but overall incomes are up. Poverty is down, right? We have not seen poverty rates this low since the 1970s. We have not seen our household incomes in Oregon higher than the US since the 1960s, right? This is stuff we haven't seen in forever. It's good news for the real estate industry. It means buyers have money. They're able to spend the money. So we see the prices going off. We see the shortages and the dynamics in the housing market aren't necessarily good overall, but they're good in the sense that people have the money and the demand is there. And so that is struggling on the production side of things, struggling on the supply chain side of things. But the demand side of the economy, unlike the last two cycles in particular, coming out of the tech bust and the housing bust, the demand side of the economy is as strong as we've ever seen. And now that the federal aid is gone, what's really important, particularly for real estate buyers, households, is labor income is booming. Here we're looking at employment on the left and total wages and salaries on the right, right? We still have a massive job hole, right? Employment in Oregon is about, well, we just got another employment report. So it's about 3.5% below where it was pre-pandemic. So there's still 70 or 80,000 fewer jobs today in the state of Oregon than there was pre-pandemic. But total wages and salaries earned by the workers who have jobs is 8. Now we're up to 9% above where we were, right? Average wages in Oregon are 15% higher today than they were at the start of the pandemic. And that's because of the underlying wage growth. And so the big question is like, well, when are these workers going to come back? I think they're going to come back in the next handful of months. That federal aid is starting to fade. The federal aid is gone, but the impact on household savings is going to start to fade. I think people are going to have to come back and take jobs for financial reasons, which they haven't had to. It's important to keep in mind that the federal government policy was such that we don't want American workers to have to work just to put food on the table during a global pandemic. And the federal aid more than did their job, right? Incomes are up. The economy is in this inflationary boom. And so that did its job, but that is all gone now. And so what are we left with? We're left with an underlying economic growth, which is really about jobs and wages. And these are doing really well. The recovery in the labor market, the recovery in employment is 3 times faster than what we saw last cycle. You can still have the jobs hole to go. We think we'll close that in the next couple of years. We think by next fall, early next winter, we will have a historic all-time high employment in the state of Oregon. That's our forecast. But you can see our wage forecast is faster now than it's ever been. We've raised the total outlook for income in Oregon. which then feeds into business revenue, feeds into tax collections and all sorts of stuff like that. But it's due to this tight labor market and inflationary boom that we're in. And so, you know, what is the risk here? Well, ultimately, what the risk is that the inflationary part of the boom is higher, longer lasting, more persistent than even the Federal Reserve anticipates. The Federal Reserve is starting to tighten policy. They're signaling that they're going to tighten policy faster than anticipated, just because the big thing here is when the inflationary part of it really started a year ago, a lot of it was tied directly to things related to reopening the economy and some supply chain bottlenecks, particularly in the automobile, right? Used car prices are up 30, 40%. If you try to buy a car, your sticker shock value in the last year, right? And that's because we can't produce enough semiconductors to put the chips in the cars, right? We have football fields of automobiles ready to go. They just need a couple computer chips slid into them, and then they can go to the dealerships around the country. So that's a very specific, narrow supply chain bottleneck that we're dealing with in matters at the national level. We also have reopenings tied to, you know, rental car prices, hotel prices, airfares, that sort of stuff we didn't do in 2020 when we were hunkering down at home to a greater degree. As we started to go back on vacations in the last year, those prices all surged, right? And so that sort of drove a lot of this higher inflation, at least initially. But since then, right, since we've kind of gotten past some of that initial reopening of the economy, what has happened? Well, the inflationary dynamics are broadening now, right? They're hitting more sectors, they're hitting everything. And so that's really what has the Federal Reserve more concerned. And we're starting to see inflation expectations tick up. Which is really matters, because it's not just about prices today. It's also about what do we think prices will happen tomorrow? Do we have the income and ability to pay those higher prices? Do firms believe they can pass along higher prices at a faster rate than they become accustomed to in recent decades? And the answer to all of these things right now is yes, right? We have the money, we have the demand, we're trying to spend it. Businesses can pass along. We've seen profit margins increase during the pandemic because the consumer demand environment is so strong. We're just absorbing anything because we have the money and we just want to get stuff. And we know it's going to take a little while longer, but we're just willing to pay through the nose for everything. And so these inflationary dynamics have shifted to something we haven't seen since the 1960s and the 1970s. And so the Federal Reserve is starting to tighten policy. They're going to raise rates faster than anticipated. They're going to bring those into certainly next year. Whether they're going to do 2 or 3 rate hikes next year, you know, somewhere in that ballpark is probably what we're going to see. That's going to put upward pressure on interest rates. And so maybe we're going to see the 3.5%, you know, maybe 4% max, 3.5 probably. You know, mortgage rates, we're already up in the low 3s. We're out of the 2s and into the 3s, and so that's going to cool demand a little bit for some big ticket durable goods, housing included. And it's not necessarily going to cool demand as much as it's going to cool price appreciation, but that's for next year. Although we're starting to see the beginning of that frankly in recent weeks. Another big thing for the Oregon economy, for Central Oregon, for the housing market, population growth. Despite the narratives that are out there, despite the conventional wisdom, despite people speculating on how, you know, who Googles what on Zillow for home searches and the like, there has been no pandemic-related migration boom in the state of Oregon. Migration in 2020 slowed noticeably during a recession, like it always does. And 2021 migration was more of the same. It didn't really pick back up. It didn't slow back. It didn't drop further, but it didn't really accelerate despite people's speculation, right? And even in Central Oregon, the data don't indicate that we saw any sort of acceleration in population growth. And to the extent that there was some pandemic-related migration, it really was on net not that much, right? Because you have people move here and buying houses. Well, what do the people who sold their houses do? Are they moving? All right. Did they move to Prineville? Maybe. Did they move to Boise? Maybe. We don't have the great data yet, but we're getting there. The new estimates are just out. And I would say the difference in Central Oregon data right now is that maybe Central Oregon population growth didn't slow as much as the state. It slowed, but it didn't slow as much as the rest of the state. So there's a relative dynamic, because if there's one spot we're going to look for pandemic-related working from home migration boom, it's going to be Bend and Hood River, which are 2 of the highest work from home communities in the entire country. We didn't see it in Hood River. Hood River lost 40 people last year, which is, the estimates are imperfect, but it's flat. Whereas in Bend, it grew 2.1% in Deschutes County, which is slower than it was in the last decade, right? So it is slower, but it's still much faster than the rest of the state. So those relative dynamics are still in play, but there's been no pandemic-related migration boom on net, to the extent that we just reshuffling the decks, the chairs on the deck, and people left and fled as they sold out and cashed out their equity. That probably happened to a greater degree, but on net, population growth is very slow right now. Looking forward for the housing market, even with the slower population growth, the outlook for home ownership across the economy, across the U.S., is very, very strong for underlying demographic demand reasons. Low interest rates are great. Incomes being up is better. But the underlying demographics are very, very favorable for home ownership in the decade ahead because the millennials are aging into their home buying years. Even in today's economy, with the high home prices, with the record student loan debt and all that sort of stuff, and delayed marriage and delayed household formations and the like, by the time you hit your mid-30s, Oregonians, everywhere I've looked in the state, in Bend, in Portland, in Corvallis, in Eugene, by you hit your mid-30s, you're 50-50 owner-renter, right? So by the time the millennials enter, they're in their 30s and increasingly into their 40s in the decade ahead. These are prime home buying years. That underlying bulge of demographics of millennials aging into these home buying years will generate a lot of demand for housing ownership in particular. So here we're looking at the raw number, increase in the number of homeowners in Oregon. You can see, right, the younger generation, that's the millennials aging, forming new households, switching from renting into buying. The older ones, which are larger, this isn't new ownership demand. This is just aging in place of the baby boomers, and it's even larger in Central Oregon. Central Oregon is growing faster, has an even larger retirement cohort than the rest of the state. And so there's a lot of aging in place, but isn't really home ownership demand. So if we switch from the raw demographics of housing by age, and we look at the buyer profile in the decade ahead, you get this, right? This is looking at, again, the demographics, the migration patterns, the changing from rentals into owners and the like. And you can see, even though we're going to have a lot more older homeowners in our economy and our population, in terms of buyer profile and the transactions, it's going to be relatively low. Most of the bulk of the transactions in the home ownership market are going to be in your 30s and your 40s and maybe into your 50s a little bit, right? That's the bulk of the people who will be buying homes because they're going to buy a home, they're going to live in it for a few years, then they're going to try and trade up and get that better home in the better school district with the bigger yard and all that sort of stuff as you have kids a little bit later in life than previous generations. Now, of course, the big risk, as always in Oregon, is, are we going to build enough homes? And the answer unequivocally for the last 25 years has been no. We're not building enough housing. Our forecast is more of the status quo. Our forecast is for about 23,000 new housing starts a year in Oregon, which is that dark blue bar of the line, the dark blue part of the chart on the left, kind of an average amount. That's based upon our population forecast and that underlying demand from a demographic perspective. But we need to build more than that. The challenge is, how do we do that? And really two things. We've seen some state policies designed to boost housing supply more than we've ever seen before in the past. The first one is the duplex legalization, the House Bill 2001, where we can subdivide lots and we can put 2 or 3 or 4 units on a lot instead of just one larger detached single family home. This will be a moderate boost to supply over the long run, right? It's a little bit more affordable, provides a little bit more walkability to our existing neighborhood. You can incorporate it into your master plans, as we're seeing a bunch of places, both locally and around the state. And there's a lot of benefits associated with townhomes versus larger detached homes, but it's not a silver bullet. It's going to take a while for this to really boost. It's the right policy. It increases property rights. It increases a lot of good things. But it's not going to suddenly change our housing market overnight, especially on the redevelopment side of things, right? As homes hit to be 60 or 80 years old, the question becomes, do you gut it and fully remodel it and put it back at a premium price point on the market? Answer is sometimes yes, right? That's what the market wants. That's what the buyer wants. Sometimes when you get a home that's 60 or 80 years old, you scrape it and you put something new in place. When you put something new in place, if you put up 2 townhomes instead of one larger detached new construction, right, you've increased the housing supply by 1 unit, right, which is a boost to the housing supply, but it's a 1 unit boost, and so it takes a while for that sort of redevelopment cycle to hit, because housing is a long-lived capital asset. And then the other thing the state has done is pass the regional housing needs analysis. It's still in the implementation phase. Some research from Echo Northwest shows, basically how much do we need for future population growth versus how much have we underbuilt historically, plus our increase in the homeless population. We need some more direct assistance for that as well. And so you get these really big numbers that, frankly, we haven't produced at this level in quite some time, and not on a consistent basis ever in our history. And so we need to do other things, increase zoning, increase land supply, increase the workforce in the construction industry, streamline the permitting process to get things going faster. Like, there's a lot of stuff we're going to have to do if we actually want to tackle the supply issue. And it's going to be challenging. But the first answer is we need to build more housing. And whether or not we do is a bit of an open question. And I'm a little more pessimistic on it. I'm optimistic that we have some policies in place now that should help. I'm pessimistic in the sense that if you've ever tried to build new units, just the public perception and outcry from some of it is pretty pessimistic to listen to. And so with that, overall, good news. The economy is strong. We're in an inflationary boom. The Federal Reserve is raising rates. Mortgage rates are going to continue to drift higher, certainly in the year ahead, which will cool that price appreciation, but that underlying demand is there. The income is there. The demographics are there. The outlook is bright. And with that, I'll pass it off to Roger. Here's my contact information. Always happy to chat. Send me a call or send me a text, give me a call, follow along online if you're interested in the research our office does. Thank you.
Okay, thank you, Josh, very much for the overview. I'll quickly just transition with the ask for questions if there's anything fresh on anyone's mind. I don't see anything in the queue at the moment, but I'll just open it for questions real quick and see if anything pops up. And while we're doing that, Roger, if you want to go ahead and get your share screen going.
I will ask a question while you're waiting for others.
Yeah.
Josh, can you talk a little about, you talked about inflation, the component that wage for longer term inflation play in, the concerns the Fed and others have regarding this, what we've always heard is temporal inflation to become longer term.
I think that's what they're starting to realize is that, again, we had some of those temporary issues that we're going to peter out, but it's broad-based. And what you really want to pay attention to is the interaction between household income, so your ability to pay, those are up. We can all pay more money. Actual inflation, that's up for sure. And then inflation expectations. And inflation expectations are based also in part on current inflation. So the higher current inflation is driving future expectations up higher. And so all three of these things are what really matter for the inflation outlook. And they're all pointing up at the moment. And so you're starting to see the Federal Reserve is kind of making a hard pivot from what they were saying even 3-6 months ago to what they're saying today, that they're taking inflationary concerns seriously, and they're going to raise rates faster than they were signaling even a couple months ago. So I think all those dynamics are pointing towards faster inflation than we've become accustomed to, and we're finally seeing the Federal Reserve realize that and start to take action, I think.
Great. Thanks, Josh.
I don't see any other questions in the queue at the moment. So with that, Roger, if you want to go ahead and give us kind of what's going on in the Central Oregon region. So.
Thanks, Kevin, and thanks, Josh. I think we're very fortunate to have such an awesome state economist, actually in Bend, so he's in tune with what's going on here as well as the rest of the state. But I just continue to be impressed by Josh and his capabilities. Keep underestimating revenue for the state, so that kicker, kicks in. So good job, Josh. Just a quick check-in, Kevin. You can see my full screen and it's not split. Okay, perfect. Well, thanks for having me on. I will provide maybe a little more focused perspective on the Tri-County region. And you think about the industry that we're speaking to today. The fundamentals are, am I going to be able to sell the same number of homes, the same amount of property that I did, the year prior? Is it going to be more? Is it going to be less? Some of the drivers really in that are population, employment, GDP, which is kind of a summary of all economic activity. And so those are the things I'm going to hit a little bit today, maybe dive in a little bit deeper on some of the population stuff that Josh already mentioned. So the slide that you have up here before you is really our census data. There is that 2021 estimate that comes out from PSU. They contract with the Census, U.S. Census Bureau to provide those estimates in between actual counts. And it's pretty interesting to see the growth if you compare on a county basis with some of our other metros, just the kind of growth we've seen. So if you look at that estimate, it's probably hard to do that math quickly in your head, but the estimates are actually a fair amount less than what the actual has been over the last decade. And so no metro in the, in the state of Oregon, at least, came close, anywhere close to kind of growth rates that Deschutes County saw again, which is interesting as well, because a lot of the forecasts said, oh, well, as Deschutes County gets bigger, it's going to be harder to have those really high percentage numbers. And yet they could continue to beat the estimates, interestingly enough. And I think one of the other kind of fascinating thing about this as well is I like to put the actual, I'm less of a tables or a chart guy than I am a table guy, because I like to see the numbers. And if you look at the actual total gain on a county basis, 40,000 new residents in the last decade. And you compare that to some of our, in many cases, much larger metros. Even Medford is still, has a fair number more people in the metro than does the Ben Redmond metro. We doubled practically the number of that, what's happening down in Southern Oregon. Only on this chart, only Multnomah and Washington counties had greater population gains on a county basis. So, we've boxed our weight with kind of what the Central Oregon region contributes to the state economy. Deschutes County by itself represents about 4.7% of the Oregon's population, but generated right at 10% of its state population growth, which is pretty remarkable that we could continue to be able to do that. So if you look maybe more on on the fastest growing in this decade period, fastest growing counties, you see 5 of the top 5, 3 of them are in Central Oregon. I think the chart that Josh represented as well kind of showed that more visually, but you see some of the gains there as well. And Clackamas County having 375,000 people, jumped to 421, and that's 45,000 people for a 12% growth rate. But you look at Deschutes County again, 40,000 on a base of 157. So pretty impressive. And the Tri-County area now, it's a little bit larger share of the state's population. 5.8 is generating 11.6% of its overall state's population growth. So pretty phenomenal numbers there. This one's a little bit hard to read, but this is actually pulled out of the PSU report. And this is actually the fastest growing cities in the region, in the whole state. As you can see, their populations in general are lower with, actually it doesn't show population data, it just shows the percentage growth, but interesting enough, Lapine and Sisters grew at 52 and both over 50%, which is pretty amazing in a 10-year period as well. So population has continued to fuel things, and it'll be interesting to see what happens with the PSU numbers, which estimate the census in between those 10-year periods. I think they were a little bit under this time. For the 2020 count. And I think maybe our estimates for 2021 might be a little bit low, just imperfect information perhaps. So that's a perspective on what's happening with, people and so forth. And migration has obviously been a huge portion of our population growth in the region for decades. That's not changed, but it is interesting. I'll have a slide here to talk about kind of more school-age kids as well. But on the jobs perspective, so you saw those huge growth rates. Well, actually the jobs growth rate over the same period from 2010 to 2020 was higher. So 38.1%. And you can see some of the other metros, just the percentage basis, and then again, the actual jobs. So if you look at Eugene, a fair amount larger MSA, coming in at numbers that are well below our actual gain in jobs and so forth. So no metro again was even close. We were only eclipsed from a metropolitan statistical area, which that's MSA, barely by Salem and certainly by Portland, but much larger base of jobs and economy that are in those areas than in Central Oregon. So once again, outboxing our weight. And our job creation in the Ben Redmond area over the last decade represented 9.4% of all new jobs in Oregon. again, while our state share of the population, for at least for the MSA, was below 5%. Something else that, this is more recent data, kind of tracking what's happened in the pandemic. I do keep hearing about recovery planning happening. I'm like, okay, well, what is it? I mean, what do you characterize as actual recovery? And if you're talking about jobs and wages and so forth, I think Josh already hit those points well. We're pretty darn recovered. This is actually data from the Employment Department, just updated last night. And you see over that 2-year period, so October clearly represents, pre-pandemic to the same period, which if you look at our employment numbers, it looks like a heartbeat. So it goes up and down over the year. And so these numbers change, and obviously the annualized part of what, Josh's comments are that we have not quite got back to where we were pre-pandemic from a jobs perspective. But on a monthly basis, you can see in our region, we have not annualized yet, except in Crook County. Crook County has regained and surpassed their annual number of jobs already. But the other communities are, on track to do that here very, very quickly. So we've got, we've got this job growth, we've got, population growth, and that's really the explanation of why we have higher unemployment rates. We've had a bunch of folks leave the marketplace and, leave the job market. So that certainly has been an impact, but they've been backfilled by new residents. And probably a fair number of the emerging workforce saying, well, gosh, you're going to pay me $717 an hour to work at McDonald's. I think I better get a job. Or maybe that's the parents that are saying that. The kids are, are following suit. But that's really how you see this, these higher unemployment rates, higher job numbers, et cetera, is that population growth. And this is a graphic that kind of represents that. So you see our Tri-County area along with other states or other counties in the state. It's generally a higher unemployment scenario from the official seasonally adjusted numbers than it was 2 years ago. And the things that are causing that, obviously, for our region, ours not alone, is population growth, but there's continued pandemic fear. There's still childcare and school challenges that are maybe keeping folks home and out of the workforce. I heard a stat here that of those that were 5 years younger or 5 years older, maybe still in the marketplace or still in the workplace, 50% of those left during the pandemic. Said, forget it. My stock portfolio is doing fine, or my investments are doing fine. I'm just going to go ahead and retire. So he lost half of those workers, kind of a mass retirement. And then we have this permanent job loss, or real and perceived barriers, is a mismatch in skills of what's available and what people kind of have to offer in that area. So it all rods to record shortages, which is the biggest headwinds we are finding right now for businesses that we serve in the Tri-County.
Roger, before you move on, there is a question, and maybe this is what you're going to hit on, but one question was, what sectors are the job growth occurring in? Is it high tech, service? Where are you seeing that the most?
Yeah, great question. We have visibility more in the traded sector, so that's going to be more in the manufacturing and tech arena. Some professional services as well. And this slide, kind of, speaks to what's happening in the manufacturing sector. I think we've seen some sectors be slower to recover, but they're starting to do so now. Leisure and hospitality is one of those that has been hardest hit in our region. We had a higher percentage. I think about 17% of our overall jobs have been in that sector historically, and those have not returned. In fact, if you look at our shortages right now on an annual basis from where we were pre-pandemic, a lot of the ones that have not recovered are in that sector. Some of them are, in healthcare because they just can't fill positions, not because there's not demand. They just can't, I think St. Charles has had this rolling anywhere from 400 to 600 person shortage in their workforce, as an example. Makes a big impact on our overall numbers, given our small size in our region. So hope that answers the question. Happy to dive more into that, or others can as well. I know Josh is probably even a better expert on this than I, but we definitely know the traded sector, and this slide talks about manufacturing. So if you see manufacturing over the last decade, or the U.S. actually had growth. If you look at previous decade periods. Sometimes that would even be a loss as jobs are kind of exported overseas, or there's productivity increases where you don't need as many people to produce the same amount or more. We actually had growth in the U.S. level. Oregon is a manufacturing state. It's not often recognized. So Oregon did not quite 3 times better as far as employment growth in that period than the U.S. And then you see Central Oregon, starting with Jefferson County, Deschutes County, and then Redmond. I'm going to give kudos to John on the sky high skyscraper there of 81% growth in that 10-year period for Redmond. I think that really speaks to some of the work that we do. That is just like, oh well, those folks would be here anyway, whether economic development was working on it or not. I think this is a clear indication that this is an outlier, and these jobs would not be here, I think, without the work that we do. And specifically for that red bar, the work that John and Reddy and the team there have done over the past 10 years. So pretty impressive. And those are some of the industries that we're seeing that have grown. What I like about what's happened with the manufacturing employment growth and the wage growth is that it's pretty balanced. There's no concentration necessarily in one sector, kind of a broad representation across a lot of these sectors. And then, I think it's interesting to talk about demographics. I'll move on from jobs. There are definitely folks out there that believe if you have a younger workforce, they call them the young and the restless. For those who are old like me, will know what that that was a. I don't think it's still on today. It was a soap, but the young and restless is kind of an indicator of current and future economic health for a region, because those folks are consumers. They buy houses, they buy cars, they have kids in schools, etc. And this is a number you don't see very much, but we definitely shop this, and I think get some eyebrows raised to the airlines when we go to pitch them for overall health of our economy. And that's 47% of the entire K through 12 student growth over the last 16 years. It's just a staggering number. So we know we have high population growth. We know we've had a ton of jobs be developed here and established in the region, but this is a place to raise kids. And you can see that in the fact that we're building on average about one new school every year. Just finishing up Caldera, a new high school, or finished up a new high school this past year. And people tend to pass bonds in order to do that, whether it's in Deschutes, Crook, or Jefferson counties. So pretty interesting stats there. And then GDP, I'll just mention that we, this is a pretty interesting graphic because it maybe picks some of our peers that we compete with for work, for projects, including the Boise area and Spokane. And it's, we're killing it. So in fact, 3 years ago, we actually had the highest GDP growth in the entire nation at 8.1%, which is just phenomenal. That kind of puts China to shame. I think when this number came out, we were the 8th highest in the world with those kind of numbers. So pretty phenomenal GDP growth as well, which is kind of the summary of all the goods and services that are produced in a particular area. And then, this all wraps up into some national rankings that folks may be familiar with. This one happens to be Milken Institute out of Los Angeles. And they compare, a whole bunch of, I think about 375 metros, both large and small, kind of break them into 2 groups. And we still remain in the top, top 3% of that. Dropped from number 1, which they'd never had a number 1 go more than 2 years. And we did 4 years before dropping to 13. They'll come out with this, the 2022 here within the next probably 30 to 45 days. So we'll be interested to see what happens with that. But it's weighted on things like job growth, wage growth, mix of industries, et cetera. I can tell you that one of the reasons we dropped to 13 is they added 2 new categories to this: housing affordability. So that played a big role, I think, in us dropping a bit because the other measures were super strong. And then there's one out of the Heartland Forward Institute, which is based out of Alabama, that also does a similar type thing with comparing those, the job growth, GDP growth, et cetera, relative on short and long term. They also add in a component that how much of the percentage of jobs or proportion of jobs coming from young companies, which we rank very highly on, and think that that part of our entrepreneurial engine for job creation is super positive. So, and then some of the things you may not hear much about is just kind of what's happening on place to start a business. Back to that entrepreneurial. Pretty interesting that Ben and Redmond out of 1,300 small cities in the U.S., ranked number 12 and 13 right next to each other as far as kind of the best place to do that, based upon a business environment, business costs, et cetera, for this 2021 survey. And I'll maybe just wrap up a little bit on a down note, but our business climate is changing. And this is probably no surprise to anyone. You may not have seen the research out of the Washington, D.C. based Tax Foundation. It's been around since the 30s. Every year for decades, they've done a business climate index, and we dropped out of the top 10. We've been there for most of the last decade, down into 15. But they have one of the pillars of that. They have like 3 or 4 different major components is corporate taxation and kind of the equity and fairness of that. We dropped to number 49, only above Delaware. And so actually California, believe it or not, is 21 spaces higher than Oregon currently, according to the Tax Foundation, something that's super concerning for us long term. And it really comes back to that we became a state that taxed both revenues and profits with CAT tax. And yet, progress continues. I'm going to skip this slide and kind of let John talk more about what's happening in Redmond, but we have seen new spec space from a business kind of industrial side of things come online, more so than we saw probably in the previous 5 or 6 years, or the last 3. And it's resulted in some pretty exciting projects that, I probably need to move on here and let John get on with his slides. But we had our first startup company go public in at least 20 years. I think the previous one to that was Bank of the Cascades, which had been in business for a long time. And then Dutchie, our first what's called a unicorn, and the fact that their valuation went over $1 billion. In fact, I think they're more in the $3 or $3.5 billion range now, based here in Bend. 3 or 4 year old company. And then we just continue to see massive development out in Prineville with the data center industry, now up to over 5 million square feet under roof in that community, generating a lot more jobs than people I think realize, and a huge economic activity for that community. And then finally, Valancy is an exciting company that out of the Bay Area that chose Bend to expand its operations, and they're a UAV firm that are all kind of tied in, some of this around pandemic, around drug delivery and so forth. But pretty cool company after many years of effort picking this region over others for their operations. So with that, I'm happy to answer any questions or pass the baton to John.
You're muted, Kevin.
I was hitting the space bar, but it wasn't working. So yeah, thank you, Roger, for your insight on all this. Really appreciate you taking time to put that together. We didn't have any questions in the queue. We just had one comment, which is they were hoping to have access to the information because this is all great information. And I told them I did have copies of your slides. So we're also recording this, and we'll be posting this presentation to our website too. So if you want to come back and revisit it, you can. With that, I still don't see any questions. So thank you again, Roger. And we'll go ahead and pass the baton to John and learn a little bit about what's going on in Redmond.
Thank you, Kevin. Thank you again as well, Josh and Roger. They gave us this kind of macro, and now we're drilling down to Redmond here. And so now you've seen kind of the data back behind what's happened over the last few years, and now you get to see some of the things not only that you can drive down the street and see today that is rolled up in the numbers, but those are the numbers that are going to be reflected in the years ahead. So these are some of the things that are happening within Redmond. 2020 was our strongest year at Redmond Economic Development. We've been around since 1988, first incorporated late 1987. And we had the best year in terms of number of done deals with 10, and our second largest capital investment at 21.7 million. Not a high job count year, but larger investment activity. We expect to have some very large investment activity with some announcements around Wild Mike's Pizza and a couple of the building material projects that we have. I'll show you some slides on later on in my presentation. But this is 2021. Obviously, that was our last year. We're about to come to close in 2021. We definitely see some headwinds that Roger alluded to, as did Josh. Available workers impacting our company's ability to scale and grow. We have some question marks about what our GDP might look like if you don't, we have customers, right? But we don't have employees and firms to serve those customers. So it'd be interesting to see what the long-term GDP impacts are to that particular situation. And with in-migration, labor force isn't growing substantially because people are moving here with jobs, right? The pandemic created this in-home work opportunity. And so we see a lot of the in-migration, people moving here, having jobs. And so that may actually be an opportunity for us in the future to see if we can't potentially attract some of that home worker that's working for a business outside of the region back into jobs that exist here. Josh alluded to the supply chain that's been severely impacted, whether it's transportation related to labor shortages or actual products. Companies today are having to beg, borrow, and steal, scratch, and claw to get materials in to build their products. There's delay on delivery times. Some of you people have bought RVs and boats. You've probably been a part of that if you bought new ones. And then that's put demand on the used market as well, as Josh alluded to. And then Redmond, because of all this activity that's happened out here, we've absorbed a majority of our smaller lots. And so it's time to build an industrial park in Redmond. We've got a couple of developers we're working with. We've been doing that for 3 years, trying to solve this problem. But we've got one business park with some smaller lots, 0.3 to 0.6 acres, where you can combine to get 1 to 3 acres. But we really need a new business park, much like we built in 2006 and 7 in the Pioneer Industrial Park in the north end of Redmond. And then while money is cheap, materials, equipment, labor, and real estate are not, right? All this demand is created heavy demand and lack of supply. And so prices are up in that space, making it more difficult for companies to invest in property and build their own buildings, or those developers that are, building those buildings, that's inflating the lease prices, which we've seen. But for the most part, if you look at another slide I have coming, that's not changing our ability to fill those spaces, because our vacancy rate's still below 3% here in Redmond. I have another slide. And then Roger alluded to it again, the political environment ahead may be very costly to business. We try and pay off some of the debt that we've incurred at the federal level with regard to the stimulus and so forth. So should be an interesting time to see how all this unfolds. Roger also talked about the recovery. So this is a recovery slide. It looks at 2020 employment, right? And then 2021 employment. And again, Deschutes County is recovered all the jobs, but the story is that, Redmond's been helping kind of lead the way out of that pandemic related recession with regard to the job losses. And so if you looked at this slide a couple of months ago, we actually had recovered at about 3% gain, and Deschutes County hadn't recovered yet. That Bend had just recovered. And I think that largely has to do with the fact that, we're less reliant on tourism. It might be the only time Redmond ever said, hey, it's okay, we don't have our fair share of the tourism that comes to the Central Oregon market, because it helped us recover. And so something that's good, we're leading the way with that. Job creation is on the positive again here in Redmond. It's a good place to be. Moving on, this is one of Josh's slides, actually. It's a different way of looking at manufacturing growth. It's a shorter run here, 2004 to 2019, comparing the county, Oregon, and the US. And absolutely, we've had a tremendous run in manufacturing. The wages were depicted in Roger's slides. We're certainly growing at a faster rate than Oregon in manufacturing by far. So 8 times the US average, 4 times the Oregon average, and it's been a remarkable run. And I think that's because we've had a good supply of land. We're in the center of the region from a geographic perspective. We're on US 97, and we're able to attract labor from the larger number of towns that we have here in Central Oregon. And so it's been a great note to the work that we've done here in Redmond and helping that manufacturing sector grow. I don't know how I just jumped to a slide that was clear at the end of my presentation, but this is the one I want. So this is what the projects in our pending project pipeline. So we have about 28 projects that are in the final stages. Some are under construction because they don't leave our pipeline until they actually turn the lights on in their facility if they're building a building, or they move in and they're actually operating there. These are the industries in our pipeline, right? And as you can see, The construction industry is also influencing our pipeline today. Building products is a huge section of our pipeline today. A lot of companies expanding in the region and new ones coming into the region to serve the housing and the commercial construction industry. And then with the income that's in the nation today, it's putting a demand on consumer goods. So our consumer goods companies are growing as well. But that slide I had before, it showed that industry diversity. You can see the diverse industry we have in our pipeline. But again, that income and that housing boom is definitely influencing some of the activity in our pipeline as well. But it's good to have a good mix of activity, including but not limited to the aviation, aerospace, and the advanced manufacturing. That's like primary metals, and in aviation, you've got metals and composites. And so we have some good diversity inside that pipeline as well. And then if you look at the size of jobs that may be created by these expansion companies and these relocation companies, we have a good mix of larger projects in our pipeline, and those largely today, 2 under construction, Medline Renewal, BaseX, and then Wild Mike's Pizza that hasn't started construction yet, with job creation in the 100+ range for those projects. But a good mix of, you know, those small and medium-sized companies for Central Oregon, right? If you look at U.S. numbers, small to medium-sized companies are, you know, 500 and above. For us, these are 6 to 100 employee companies. Nice mix of companies. What's nice about this, and I think you see in the slides, is when we bring these companies in, they're 6 and 20 employees. It doesn't take long for them, a few years, sometimes less than a decade, to be 100 or 200 employees. BaseX, for example, is 6 or 7 years old. They're 200 employees. When they got here, they were in the 30 or 40 employees. And so a good example of sort of how companies can come into Central Oregon and grow, largely due to the fact that logistically we're a great place if you're shipping smaller products, even though BaseX ships larger products. But we're also have a really trainable workforce, and that's what we hear from our employers widely. So, and then recruitment, business expansion is a split mix, which is kind of a nice place to be. We have typically been a little heavier on the expansion side of things. Last time I reported these slides, we had about 34 companies in our pipeline, but some of those projects are on the ground. I'll get to some slides on that in a minute. So I did add a new startup yesterday. We don't have the same share of startup activity in our pipeline that you might see in Bend, but I did add a new company that just moved to town here that's in the startup tech industry. So we now have 2 tech industries that we're serving here. So we're gaining some momentum. We're up 100%, Roger, in tech industry development in 1 year. So it doesn't count when you have those lower numbers. And then what's the activity on the ground, right? This is our vacancy rate and sort of the decline of that vacancy rate. Back in the Great Recession, we were close to 30%. This is a decline of that. We've been hovering around 3%. And this is Compass Commercial data. I need to give credit to them. They do the survey on a quarterly basis. On the bottom of the screen, you can see we were as low as 1.14%. We're at 2.14% in the most recent report. And so this is those buildings that we've been building, which I will show you a slide on in a minute, that have been getting filled up, right? So we've built quite a bit of space. So speculative development, permanent or under construction. We have 13 buildings right now in Redmond. There's a couple of projects that have 4 buildings on their site. One has 7. Other than that, it's mostly single or 1 or 2 buildings on these sites. But delivered to market over the last 3 years, and again, this is 2018 to present, we've had 12 buildings come online and almost 125,000 square feet, all of which have been absorbed. And so it's good that we have more coming, but I expect that by the time those are available for occupancy, that 50% or better of some of those buildings will be filled up just because of the demand that we have. And then we have 8 buildings planned. So what's the difference between these categories? 1, permitted or under construction means they've been through City Hall. They've at least started a process of their permitting. They may have a land use permit already, but they may be into their development permits related to, you know, mechanical and so forth. Delivered to market, obviously that's already here. But plan means they've shown me a development plan or a site plan, but it may not have hit City Hall yet. So this is ready research. This comes directly from our research. And then 3 more buildings sort of coming soon, if you will, meaning they got their plans, everything's ready to go. They're just waiting to pull the trigger. And what does that look like on the owner occupied? So completed buildings, 9 over that 3-year span, almost 200,000 square feet, 6 buildings, 3 of which I mentioned are planned. Under construction, I mentioned BaseX, Medline. So you bring all of this together and you've got, you know, over 600,000 square feet of space that have either hit the market or are planned under construction here in Redmond. That helps our tax base out, and we've been working diligently on making sure that that momentum continues just because of the demand that we have for this space. Someone asked earlier about where the jobs are coming from. This came from Damon Rumberg in a report at the bottom of the screen there. You can hear the narrative, but this is where some of those jobs in the recovery are coming from. Leisure and hospitality is making a boom, a climb back in after pandemic-related losses. Obviously, a lot of people here this summer, so you can see what some of that growth has been. And then construction is still continuing to grow. This all despite the fact that I think if we had, so that's, almost 2,500 jobs, if we had 2,500 people walk into our region right now for these industries, suffice to say, every one of them would be employed. I wish we could just hit the easy button and have that happen. Because think about what Central Oregon's GDP would look like if we could just do that, right? We'd be able to go to Walmart after 8 o'clock, at least in Redmond. So a lot of changes in shifting hours because we just don't have the workers to get there. And so continuing on, development activity. These are some of the companies behind the numbers that I just shared. I mentioned BaseX, huge expansion. What a statement. You saw the manufacturing growth slide. You drive into Redmond from the south end, and Redmond's really got quite a mix of industry and manufacturing. That's a big statement that proves it there on the right-hand side of the road as you enter from the south. Performance Pro Supplies building up on Tamarack, Expion 360 built down off of Deerhound. Several speculative spaces. These are pictures were taken yesterday. Not as nice a day as the day before. These are owner, user, and flex spaces. Tarragon on the left, one over off of Tamarack that I mentioned. In the middle, in the middle is the one on Veterans Way, and then Medline Renewals project on the right-hand side. And then companies behind some of these as well. These are the larger ones. Wild Mike's Pizza, that's a rendering of their space at the corner of 9th and Antler. Nosler's in a process of developing their 60-acre parcel to relocate operations out of Bend. Pacific Coast Supply, a large building materials dealer that fit into that mix of companies I mentioned, is in a process of pre-development and land use. And then finally, Bridgemasters, who manufactures equipment to work on and maintain bridges. They're out in Alfalfa, is going to build a building here in Redmond. So some of the names behind some of these construction projects. And then lastly, I'll just say, a big next step for us is the development of our large lot industrial, over 600 acres down south in Redmond. It's currently listed with Cushman and Wakefield, but we're starting to talk about infrastructure so we can deliver those sites to this growing demand for our marketplace. These are larger lots, 50, 100, and 200 acre parcels. And we think this is our next location to land a big fish, much like Wild Mike. So we're looking forward to that. So I had a slide in there with events. I won't cover it. See where I'm at on time here, but I think I wrapped it up in 14 minutes and 52 seconds. So I hope that isn't too fast. I can take some questions.
So I know you guys have another meeting at 10, so we'll just open it up for quick questions. There was one in the queue. They were just wanting to know where the best place to find resources such as this, where they can get that on a monthly basis. Is there a place they can go to get some of that information?
So Josh had a hyperlink in there for some of his slides that he reports on a regular basis. I won't steal his microphone. Ours come out typically at our events and our newsletters for Ready and EDCO. So if you want to see this stuff on the regular, join EDCO, join Ready, come to our events. So that's one way to do it. I'll stop and let others speak.
Yeah, and Josh just put the link in the chat, so you guys can copy and paste that straight out of the chat there. And also, I know John just put that plug in. I was going to say the same thing is, I know being in the title industry, we're related to the real estate industry, and everyone on this call is related to the real estate industry. And we can credit a lot of our past success to the work that you all do. And so if you haven't joined EDCO already, I would encourage everyone on this call to do so and support the efforts that's being done there. So
appreciate that, Kevin. I might just do a quick shout out to Josh and his blog. I look at it on a regular basis. It covers a broad variety of things that are happening in the state. So it's not just, all about, the state's revenue and tax collection and so forth. It's around population and demographics and, interest rates, et cetera. I found it to be just an excellent resource, and Josh does a great job of kind of summarizing that in a digestible form. So I check out his blog probably on a weekly basis. So it's excellent information there. We have a pretty comprehensive website as well at idcoinfo.com with lots of different pieces of information that you'll find as that information becomes available. And kind of the biggest distillation of that is in our economic profile, which we'll be updating here as the year gets started for 2022.
Awesome. I don't see any other questions in the queue. Oh, Josh, did you want to add anything?
Yeah, just the first link in there is our website where Roger was kind enough to talk about. Another one is qualityinfo.org. I know it's a weird URL. That's the employment department's website. So like you can go on there and click by county and get that raw employment and unemployment rate stuff. And then some articles written by Damon. And I don't know who the new workforce analyst is for the area. But they're in the process of hiring that. So anyway, that's the employment department stuff versus our stuff. It's all right there.
And it looked like I thought someone raised their hand, but now I don't see it. So I thought someone was raising their hand, but now I don't see them. So wait, here we go. Nope, no other questions. I don't see any other questions in the queue at the moment. So with that, I know you guys have a hard cut. You got to get to another meeting. So thank you all for this information, taking time out of your busy schedules to do this. It's been a wealth of information and knowledge, especially as we're all trying to plan and head into 2022. So much appreciated. And we wish you, Roger and John, good luck in the next year. And so wish you guys all the best in your future endeavors too. And thank you again, Josh, for taking time. I know you guys are always swamped, so appreciate you spending time with all of us here this morning. So I'll answer the one most common question, which is when will you get your CT? It's your continuing education certificate. We will email those out by Tuesday next week. So you should have those, just check your inbox. With that, we'll go ahead and conclude. Thank you all and have a great rest of the week and happy holidays. Thank you.